Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Mathew. Your portfolios are currently looking significantly better than they did in March this year, and that's because markets have rebounded quite substantially, particularly at the broader end of the spectrum. Mid-cap index is up as much as 18% from the 1st of April to now, and the small-cap index is up about 25%. So if you're focused on the Nifty 50 and you're trying to get that to tell you what the market is doing, well, the perspective is entirely different. But if you look at mid-cap and small-cap funds and you judge the performance that has been seen over the last 3 months, and you try to look back over the last 7 years or 5 years to see whether these very schemes rank there, the picture might actually be a little different. I'm joined today by Harsh Kumar of Zvest, and we're going to talk about some of these factors and how you should make your decisions when you're investing in broader market funds. Harsh, thanks so much for taking the time. Let me first ask you about the outperformance of mid-cap and small-cap. In your opinion, why is this taking place?
So Alex, before I start the conversation, you said the context very right, that 2026 has not been one market, it's been 3 different markets: large cap, mid cap, small cap. And the investors have had very different experience depending on the pocket where they were invested. Now, before discussing what happened after 1st of April or 30th of March, let's see the correction itself. So from 1st Jan 2026 till the lows of 30th March, all the indices, Nifty 100, Nifty Mid Cap 150, Nifty Small Cap 250, corrected by around 13 to 14%. Now, the assumption is when the correction is same or similar, then the rebound should also be similar, but that's what it didn't happen. And like you mentioned the numbers, that mid cap and small cap delivered significant outperformance over Nifty 100, which was up around 10%. But here, I would also want to say that you can't paint all the large cap in the same brush, because if I look at large cap universe, a subset of it, which is Nifty Next 50, delivered 21% performance, which is higher than what mid cap delivered. Now, the problem in large cap has been the top end of the large cap. So we have an index called Nifty Top 10 Equal Weight. And for the purpose of viewers, it's nothing but top 10 stocks with 10% weight. And that segment or that index has delivered only 4.5% return. So what we have seen is that large caps underperformed significantly, because of which even Nifty 100 performance got reduced or got compromised. Now, let's look at what are the reasons on why mid and small cap outperformed. So first, and the obvious one, is earnings. Now here, rather than getting into last quarter's earning, let me take data set for last 8 quarters, because I need to have a sufficient sample size for me to arrive at a conclusion. Now, if I look at last 8 quarters and if I take adjusted PAT for Nifty 100 companies, there has been only 1 quarter, which was December quarter, where the earning growth was above 10%. If I look at the similar thing for Nifty Midcap 150, then for last 6 consecutive quarters, their earning growth has been more than 15%. Now look at the difference here. Now, coming to small cap, in small cap, we had the best quarter in September 2025. After that, there has been some moderation. But despite that, small cap has been holding on to double-digit earning growth for last 3 quarters. So earning difference is clearly there between large, mid, and small. Second is the correction itself. Now, while we're discussing the average correction, let me get into the stock-specific correction. If I look at the data as on 30th March, and if I take Nifty Midcap 150, 40% of the stocks on that particular day were down by more than 30% from their peak. And if I look at Midcap 250 or Small Cap 250, then 40% of the stocks were down more than 40%. So what is happening here? There is a value which is emerging between mid and small cap, because a good number of stocks are down 30 to 40%. And when there was a relief rally on account of ceasefire, some of these stocks, because of value buying, went up going up. Third is the flows, which most of us talk about, and I'm sure many viewers would be interested in that. Now, let's look at the flows from 1st April till now. What has happened? Foreign institution investors have been net seller to the tune of around 1.5 lakh crore. Now, that's a staggering number. Within this, we don't have the market cap-wise data, which is released by NSDL or exchanges, but we get sector-wise data. And if I look at the sectors which have contributed to FII outflow, first is BFSI, where the outflow has been to the tune of 40% of this 1.5 lakh crore, followed by oil and gas, followed by large cap IT services,
Right.
and then FMCG. Now, all these are a part of large cap and not of mid and small cap. While if I look at mid and small cap, DII flows have been very, very strong. If I look at mutual fund flows itself, last 63 months, we haven't had even a single month where mutual fund net equity flows were negative. Now,
Sure.
you have domestic institution piling on to mid and small cap, foreign institution leaving large cap, and that's the reason we are reaching this situation. Now, I must, before I end this question, I must tell our viewers also that at this point of time, there is a view which is emerging among portfolio managers where they are constructive on large cap and they are cautious on mid and small cap. So please don't try to extrapolate the returns of mid and small cap for last 80 days into next 80 months. So be careful about it.
Yeah, it's an important point that you raise. But having said that, Harsh, it must be pointed out, and I think viewers of this program have also pointed out in the past, that we tend to look at time frames to kind of judge the performance of mutual fund schemes, but the tendency is to look a little shorter. That's not what we're trying to do. We're trying to actually give you perspective on how mutual funds have behaved in a certain time frame, but we always do look at the longer term time frames. What I want to understand is you can actually outperform as a mutual fund either by falling less than the market when it is falling or rising more than the market when it's rising. Very few funds manage to do both. So when we look at the outperformance in this period where there has been a rebound, which schemes stand out?
So, Alex, let's first look at the universe itself. So first, mid-cap. There are around 33 schemes in mid-cap. And if I look at the data between, say, 30th March and 22nd of June, which was the day before yesterday, there have been 13 schemes which have outperformed the benchmark. And there are close to 5 schemes which have just been at par with benchmark. So we can safely say that there are 18 schemes out of 33, roughly 55%, which have either matched or outperformed the benchmark during this period. Now, the standout performers in this has been HSBC, Helios, JM, Invesco, and these have outperformed the benchmark by 5 to 9% in last 3 months. So if you try to extrapolate it on an annualized basis, the alpha would look significantly higher. Now, moving to small caps, there are 36 schemes. Here again, 15 schemes outperformed the benchmark and close to 5 schemes broadly matched it. Now, the picture is remarkably similar to mid-cap because here also 55% of the schemes either matched or outperformed the benchmark. Now, the best performing schemes in this have been JM, Bank of India, Motilal Oswal, and Helios Small Cap. Now, the interesting observation here is that apart from Motilal Oswal, which has a AUM of around 6,500 crore, all the other schemes have an AUM of less than 2,000 crore. And if I ignore Bank of India, all the other schemes are less than 3 years. So what is the reason for the outperformance? A common thread across most of these funds is that they have been relatively low on cash, where a certain fund manager took calls on cash. Second, these were the funds which didn't have higher allocation in large cap. Now, the viewers may question why large cap, because by the mandate, mid cap and small cap, they are bound to have 65% of the allocation in their respective market cap categories. But there is a freedom with the fund managers to play on the remaining 35%. In order to manage liquidity, in order to manage risk, they have some part of that 35% into large cap. And wherever that was on the higher side, those funds underperformed because 4.5% performance by top 10 stocks dragged that down. Now, again, I must question the viewers here that 3 months performance, like you mentioned, is not an indicating of long-term return. So you need to look at long-term return to arrive at a conclusion.
So therefore the question arises, you've pointed out that quite a few of these schemes that are outperforming, Harsh, don't have a very long history. But if you look at the broad space as a whole, if you think about those that are in the top quartile, how have they done where relevant and where the history exists over the last 3, 5, and 7 years?
So, Alex, again, for small cap, I can't do justice because, like I mentioned, almost all the schemes other than Bank of India are less than 3 years. So let's ignore small cap and not analyze it because it may give a wrong picture to the viewer. In mid cap, if I look at, again, we have out of the top 4 performers, Helios, which is 15 months old, JM mid cap, which is 3.5 years old, where again, we don't have a performance track record of 5 years and 7 years. But if I look at other funds, which is HSBC and Invesco, for last 3 years, HSBC has done quite well in terms of performance. Whereas if I look at Invesco, this has been much more consistent over last 3, 5, 7 years. Now, again, for viewers, the test of the fund is not how it has done in last 3 months or 1 year, but it's a question of long term. And sadly, here we don't have enough data points for these top performers on how they have done over a longer period of time because they were not existent for this period.
We'll circle back to that. We've spoken about the outperformers, Harsh, but what about those that are not necessarily doing well? Are there schemes that have ranked, if you look at the longer time frame, say 5 years, 7 years, in the top quartile, but over the last, say, 6 months or even in this outperformance period, are ranking in the bottom quartile, and why?
So this is a very interesting question, Alex. So let me take mid cap first because this is relatively less interesting than small cap, and I'll come to that. So in mid cap, there are two schemes which have underperformed YTD and which have been consistent performer over a longer period of time. And one is HDFC mid cap, and second is Motilal Oswal mid cap. Now, if I look at HDFC mid cap, it is also the biggest mid cap fund in the industry at an AUM of 97,000 crore, while Motilal Oswal is the fourth biggest, again with a sizable AUM of 36,000 crore. Now, if I see the performance over longer term, HDFC has been very, very consistent. If I take any time period from 1 year to 10 years, there has been not even a single time period where HDFC underperformed benchmark. While we can't say the same about Motilal Oswal because last 4 years, it's been having a little rough patch. Now, if I look at small cap, it's very interesting, like I mentioned. Top 8 funds by AUM in these categories have underperformed the benchmark. And to name a few, Nippon, Tata, DSP, Kotak, Franklin, Bandhan Small Cap, SBI, Axis, HDFC. Now, if I look at these funds for a longer period of time, funds like Nippon, HDFC, SBI, Axis, they have a very, very good track record for 5 to 7 years and even 10 years plus. Yet they find themselves in lower quartile. So what could be the reason? So one reason is that when the fund become large in this space, there is a drag which starts applying to them. So like we discussed earlier, 65% of the money has to be kept in small cap. But beyond that, to manage risk, you have to take some exposure in mid and small cap and in a time mid and large cap. And in a time period where large cap significantly underperformed, these funds end up having underperformance. Second is that some of these funds have become very big in terms of the number of stocks they play on. So let me take an example of Nippon and Bandhan. Now, both of these funds have close to 250 stocks. Now, if you are managing 250 stocks, the ability for the fund manager to play active on active share reduces significantly. And that also leads to a situation where in times like this, you end up underperforming.
Yeah, that's a good point. Okay, I do want to also ask you about the volatility that these schemes have displayed. And this is a measure of standard deviation because a lot of people jump into small cap because they have the potential for higher return, but the experience is not necessarily very great if you don't have the staying power. And there can be a situation where it can lose a lot of ground very quickly. So what are the standard deviation readings on these?
So, Alex, I'll just take 30 seconds to explain what standard deviation is. Now, standard deviation being high or low does not mean that the fund is good or bad. Standard deviation is just about dispersion. Just to give an example, there are two cricketers. One always scores between 30 to 70 runs in all the innings and remains very close to average of his career. That is a low standard deviation. While there is another cricketer who scores 10 runs in first match, 100 in second, 0 in third, 200 in fourth. That cricket is also equally important, but it has a slightly higher standard deviation. And that's what funds also display. Now, if I look at mid-cap category, in last 3 years, and here I've taken standard deviation data for last 3 years, calculated on a daily basis, most of the funds have been in the range of 14 to 17% in terms of standard deviation. The benchmark standard deviation is 17%, which means most of the funds have been having lower volatility than benchmark. HSBC, which has been the best performing fund for last 3 years, coincidentally has had the highest standard deviation at 18% plus. Now let's look at small cap. And again, very interesting observation. There has been not even a single active fund which over a period of last 3 years has had standard deviation more than benchmark, which means all the active funds had lower standard deviation than benchmark. Now, you could immediately jump to a conclusion and say that, look, active fund managers are doing a very good job because they are not just giving return, they are also managing the risk. But there is a technical reason to this also. Small cap index is always into small cap stocks to the tune of 100% allocation. While in small cap mutual fund, you can have 10 to 15% allocation in large cap also. And large cap, because they are less volatile at a blended level, your standard deviation seems to be on the lower side. Second reason where I should give credit to the fund manager is that many active fund managers, they reduce the portfolio size in a way where they remove allocation into speculative stocks which have higher standard deviation. Now, when you remove those stocks, definitely the standard deviation of the portfolio come down. So as a result, most fund looks better on this. But ideally, I would want to compare a fund which has all the stocks in small cap versus small cap 250 index, which is not there in the industry at
That's
the moment.
right. And we're running out of time, but Harsh, the bottom line, right, which is what should you do with this information? And that's why we say that we have actionable insight on this show. So what you've told us is that the schemes that have outperformed over the last few months are those that are smaller in size, that are more nimble, that don't have large cap allocation. But should you extrapolate that to make your decisions on incremental investments? How should you decide? And do you have any schemes that you're recommending? Not necessarily recommending, but those that you like.
So, Alex, I would always say that we should look at any category of funds over a one market cycle. And for small caps, the market cycle can be really long, because if I look at the time period from 2008 till 2020, which is for a period of 12 years, small cap index in itself delivered less than saving bank returns. So the index return was 3.1% average on a CAGR basis. So you should be very cognizant on where you're betting and what has been the track record for the fund for 5 to 7 years or even longer. And sometimes having some cash, sometimes having some allocation in large cap is helpful also, because we have seen situation where certain small cap, not mutual fund but PMSs, were not even able to honor the liquidity commitment during 2018 to 2020 period. So I would suggest viewers to look at risk parameters as well. So to suggest a few funds, like I was saying, that if I look at long-term picture, we have Invesco, which has done well in mid cap. We have HDFC, which has done well in mid cap. If I look at small cap, then Nippon has done quite well. And coincidentally, this is also one of the biggest fund in small cap category. And then we have other funds like Bandhan, SBI. SBI has been lagging a bit for recent time, but the fund management is really good.
On that note, thanks so much for taking the time, Harsh. Pleasure speaking with you.
Thank you, Alex. Pleasure's mine.